Alright, this video will teach you something that took me years to understand, but which will serve you for life. Here's a graph of the S&P 500, that means an index that tracks the 500 biggest US companies in the world. And here's a question for you. What do you think is the future performance of the 500 biggest US companies the following year? Difficult question, I know, but to help you, here are three possibilities. First, it will go up by 30%, or it will go down by 30%, or it will stay about the same as it is now. Or in other words, you have a 43% chance of picking the right answer. Alright, in fact it went significantly down. And what if you thought it would go up and decided to invest right at the top? You might be right or you might be wrong, but the truth is that even if you think you can always pick the right answer, no one can predict the stock market. Hi, Jared here, and today let's talk about speculation, and we'll see why you're probably wrong when picking stocks, what approach you should have, and how to change our irrational thinking. And first, the price of buy versus the value you get. I recently ran across some of the market news, and it couldn't be more random than that, to be honest. Let's simply type stock market today in Google, and there we go. What's the stock market doing today? Why is there a market crash? Will the stock market crash in 2022? Should I sell my stocks before a crash? And so on and so on. There are many factors that influence the stock prices, but that have nothing to do with the company itself. One investor may take a bullish view of the economy, while another is bearish. Some investors may anticipate an advantageous market, while others are encouraged by a change in company leadership, the release of a new product by, say, Microsoft or some other company, or their own interpretation of the company's relationships with their suppliers. It could be anything else. To give you a better idea, here are the numbers related to Microsoft. You can clearly see that it has an increase in net income over the last 5 years, so around 32% a year on average. The company has been paying dividends continuously for more than 17 years, with a current dividend yield of roughly 1.17%. Moreover, it has a good increase in return on capital of 22%. And here is Microsoft's price over the last 5 years, and since the beginning of the year, it went significantly down, losing 30% of its value. As you can see, while the company is still highly profitable, its price is plummeting, and this is simply due to random investors selling their shares, because everyone is doing so. To give you a broader view of the market, here is the S&P 500, so the performance of the 500 biggest US companies, and the index lost 25% of its value. But did the companies sell 25% less products and services than last year? Well, nope, they did not. And now let's talk about the only model that predicts the market. So, to avoid leaving you with a terrible taste in your mouth, allow me to present to you the one model that appears to be doing a pretty fine job these days. And over the last 15 years, this model has properly anticipated the stock market's ups, downs, and in between. The kicker is that it even predicted the severe recession in 2008, and the model is also free for anybody to use, simple to understand, and, well, fun to watch. And I've built it just to show you one thing. I've taken Tiger Woods' performance found on Wikipedia and the Dow Jones performance on a website called Microtrends. And here's what I found. As you can see, Tiger Woods' overall score always predicted the next move of the stock market. Seems wonderful, right? But there are at least two drawbacks to it. And first, even if it appears that both are strongly correlated, in fact, they are not. End of the story. One is an American professional golfer, while the other is a basket of 30 of the most traded stocks on the market. That's it. And secondly, Tiger Woods stopped practicing in a tournament, so the graph cannot be updated anyway. Which brings us to the right approach to investing. Alright, after everything has been said, you've probably figured out what is the best approach and safest approach to investing, whether it is the stock market and real estate market, or even cryptos, although these are bloody volatile. Simply put, always invest in the long term. Because no matter what you do and what investments you make, you will always face a period when the markets will go down. On average, there are around 3.6 years between each bear market, and nope, you cannot wait for the end of a bear market, then invest all of your savings, then wait again 3.6 years to sell and enjoy the rest of your life. Simply because this is an average, and markets are sometimes based on irrational decisions made by people like you and me, called investors. And an investor is someone who only needs a few $5 to buy a share and become an investor. And keep in mind that bear markets last for about 10 months, when the bull markets tend to last 2.7 years, so 3 times more. And assuming a 50-year investment horizon, you can expect to live through about 14 bear markets, give or take. Although it can be difficult to watch your portfolio dip with the market, it is important to keep in mind that downturns have always been a temporary part of the process. At least we can learn one thing from it, it's that predicting the future is really not something humans beings are very good at, other than Tiger Woods, of course. So what do you think about my point of view of the stock market itself on the long term? I would be highly interested to know your point of view. Thank you so much for watching, feel free to leave a comment down below, subscribe if you want to see more, and I will see you in the next one.